Ladies and gentlemen, esteemed colleagues, and fellow investors, today, we turn our attention to the significant movements in the U.S. stock market on April 21, 2025. The market experienced a modest recovery following a week of sharp declines, with the major indices such as the Dow Jones, S&P 500, and NASDAQ all showing signs of growth. However, these gains were not enough to completely offset the substantial losses incurred in the preceding trading sessions. Let's begin by taking a closer look at the performance of the key indices. The Dow Jones Industrial Average rose by 0.9%, reaching 39,500 points, largely due to the recovery of industrial and financial stocks. The S&P 500 saw a 0.7% increase, hitting 5,810 points, driven primarily by improvements in consumer and energy stocks. Meanwhile, the NASDAQ recorded a modest gain of 0.4%, reaching 16,300 points, supported by the rebound in major technology stocks such as Apple and Microsoft, although it continued to face challenges related to global supply chain concerns. There are several key factors that contributed to this recovery on April 21, 2025, and it is important to understand the underlying causes. Recovery from the previous sell-off. The most immediate reason for the rebound was the technical recovery from the sharp sell-off that occurred the previous week. The market had been significantly affected by concerns surrounding the geopolitical situation in the Taiwan Strait, where tensions between China and Taiwan escalated. These fears triggered a broader sell-off in the markets, especially in sectors dependent on global supply chains, such as technology. As is often the case in these situations, investors began looking for buying opportunities after stocks had been oversold. Many of the companies, particularly in sectors like technology, had seen their share prices fall to levels that some analysts considered attractive. Despite lingering concerns about trade tensions, the recovery of major indices indicated a temporary stabilization in investor sentiment, with the market beginning to adjust to the uncertainty. Positive earnings reports from major companies. Another key factor contributing to the market's recovery was the release of strong Q1 earnings reports from prominent companies in the consumer and energy sectors, such as Procter & Gamble, ExxonMobil, and Chevron. These companies reported solid results, particularly in light of the rising oil prices. The strong earnings from these firms helped to bolster confidence in the U.S. economy. As the price of oil surged, the energy sector saw an uptick, which in turn contributed to the broader market's recovery. Investors were reassured that despite some volatility, sectors such as energy were performing well, demonstrating that parts of the economy were still thriving. Moreover, the positive earnings also provided a reminder of the resilience of certain industries amidst broader economic concerns. As consumers continue to spend, particularly in sectors like energy and consumer goods, it was clear that the American economy still had strong growth drivers, which helped to stabilize the market in the short term. Federal Reserve's interest rate policy. Lastly, a major factor influencing the market's performance was the ongoing monitoring of interest rates by the Federal Reserve. Over the past few months, the Fed had raised interest rates to curb inflation, which had put pressure on technology stocks and other growth sectors. Higher rates generally make borrowing more expensive, which can dampen corporate profits and slow down the economy. However, on April 21st, there were growing signs that the Fed might pause interest rate hikes in upcoming meetings. This prospect brought relief to investors, especially in the tech sector, which had been feeling the heat of higher borrowing costs. The market reacted positively to the idea that the Fed might temporarily halt its tightening cycle, allowing for some breathing room for growth companies to recover. Investors remain cautious but hopeful that the Fed's actions will strike the right balance between controlling inflation and ensuring that economic growth does not slow too dramatically. This delicate balancing act by the Federal Reserve continues to be a significant factor in market movements.